The bottom line is that what investors really want to see companies do is to actually invest in something that has the potential of making profit and turning into revenue. At this point, we're still struggling to see that in a lot of these companies, which is why we're struggling. Good morning. Welcome to Life in the Markets. My name is Tim Russell, and today is Monday, August 3rd, 2026. Can you believe that we are already in August? The summer is almost done. My boys are about to go back to college. Where has this year gone? Today, here in Life in the Markets, we're going to review for you a little bit about what happened last week, kind of give you an update on where we are for the entirety of the month of July, as well as kind of just give you a sense of where we are in the market year to date. So we're going to look short time, little longer time, and then kind of looking at the year in its entirety. Now, before we get going too far, I wanted to remind you, Life in the Markets is our attempt here at the Life Financial Group to provide you biblically sound direction, guidance, thoughts on how to process the markets as you're bombarded with lots of secular ideas all the time. We want to keep you, your heart, and your mind focused on the things that matter most and focused on eternity. With that in mind, let's dive into today's episode. The markets over the past week were marginally higher on all of the major market indexes. If we look at the S&P 500, it was up 1%. The NASDAQ was up 0.5%. The Russell 2000 was down a little bit. The international markets being up about 2%. Obviously, that sounds pretty good and pretty exciting, but what you miss when you just look at the numbers from point A to point B is all of the things that happened in between. And this past week was a roller coaster ride of a week, certainly in certain segments of the market. What we're seeing is a trend that we'll see confirmed as we look out in larger swaths of time. It's that higher value companies that have grown substantially over the last few months and perhaps years, have been seeing profit taking coming into these stocks. So if you have been holding a stock that's up 50, 100, 150%, and you're looking at all that's happening in the world and in the markets, you're looking at earnings reports and you're saying, well, we're not seeing profitability yet with all of this AI invention or investment. Now might be a good time for me to take some of the chips off the table and de-risk my portfolio a bit. That seems to be what's going on. This week, we're noticing that in the semiconductor space, as well as in the AI aggregator space, which they're not all the same things, there's a little overlap here, there was immense volatility. So let me just give you an example. Micron, one of the semiconductor companies here in America, was at one point down 20% just from the beginning of the week till roughly midweek. So we're looking at 2-3 days. The stock dropped 20%. Now, this stock has been a high flyer. It's still substantially in the gain category year to date, but seeing a 20% drop is pretty wild. Well, but hold on. It ended the week only down a mere 10%. If that's not volatility, then what is? Well, okay, let's look at another. AMD, another semiconductor. This was down also about 20% midweek and ended the week only down about 9.7%, a little better than Micron did. We can look at NVIDIA, down 9%, ended down only 3.5%, or Intel off 10%, down only 2% for the week. So we saw a tremendous amount of volatility within these names. So what do you make of this? What do I make of this? Well, I think what we're seeing is that there's a lot more hesitancy about the long-term ability for these companies to maintain the valuations that they've enjoyed given the investment in AI, not necessarily playing out the way we would want. What we're seeing is that these the earnings reports are coming out with CapEx spending still being elevated, and all of the money going into these chips. The stock market is not rewarding companies for having massive cap expenditures, which is a very different play than where it was just a couple months or quarters ago. A couple quarters ago, you threw in any kind of money into artificial intelligence, into building up your data centers, and you were rewarded richly by the market. Today, it's a different story. The markets are fickle. They really are. Sometimes they'll love it, sometimes they'll hate it. Now, obviously, there's been a lot of new data that's come to the market. We've seen profitability struggle with some of these companies. Google, for example, is using almost all of its free cash flow to invest back into its capital expenditures. The bottom line is that companies, what investors really want to see companies do, is to actually invest in something that has the potential of making profit and turning into revenue. At this point, we're still struggling to see that in a lot of these companies, which is why we're struggling. On a weekly basis, it was a wild week in the stock market. Even though the numbers don't look that bad, we were positive. Let's just jump in and take a look at where we are for the month of July. For the month of July, we have the market largely being down. Most of the major market indexes are lower. S&P's off just a hair. NASDAQ is off 6.7%. The Russell 2000 is off 3.4%. And the international market, this is the only bright spot in the market, being positive 1.7%. We can see gold was up, silver was down. Oil, this is a painful one. Everyone going to the pump is making comments and feeling the fact that oil is up 23, almost 24% over the past month. It's down 3% from where it was last week, but still elevated from where it was a month ago. And we see bonds are lower. Bonds are down 1.6%, but take a look at the 10-year Treasury. This is one that's very shocking. The 10-year Treasury is actually up 7%. So after we've now completed 7 months of market activity, where are we now year to date? Actually, the market's still looking very strong. We're up 9.4% on the S&P 500. The equal weighted S&P 500 is actually up 12.25%. The NASDAQ is up 16.5%. The international markets continue to look strong at 10% positive for the year. Looking at where we're at in the overall market, we're seeing a shift this year, this past week, this past month, this entire year, from high growth, high cost to maybe a little less growthy, more value-oriented names, more smaller in its capitalization. So that's why the equal-weighted S&P 500 is outpacing the standard S&P 500. That's part of the reason why we see the Russell 2000 up 17.75%, outpacing all of the other major indexes. The Russell 2000 focuses on smaller companies. We're definitely seeing a substantial shift in the overall attitude of the market. So what do we take from this as investors? I think what we have to take from this is we still have to be cautious. We have had a great amount of growth year to date. I think the growth has been a phenomenally helpful thing, but at the same time, there's a lot that could go wrong as we head into the midterms, as we see what's going on. One of my biggest concern is that with oil where it is, with the price of gasoline where it is, we're already looking at a midterms that's going to be hard on the Republicans. With gasoline staying where it's over $4 a gallon in most places in the nation, that's going to make it even harder for the Trump administration to make its case that it's actually good for the American economy. that its policies are winning, that it is wise. Now, all of that to say, there's a lot of stuff that the Trump administration is doing that I don't love. I really want it to get itself out of trying to run and control companies investing in things like Intel and other things like that. I don't want him to be doing more tariffs. We've got news on tariffs this week, how we have a new round of tariffs coming out. Tariffs are not good for inflation. They're not good for America. I don't care what Donald Trump says about it. They're not good. Tariffs, there's a better way of going about it. Tariffs are not it. And then ultimately, we want to see more freedom coming to the markets. We want to see more businesses started. We want to see more generation of income and less regulation. So if we could keep on that track, I think overall that is a better place for the market to be. As we wrap up today, last week, the most important thing in the news was we had a Fed meeting and they chose to keep interest rates the same. No surprise there, kind of what everyone expected. As I look at the projections for the rest of the year, many of the experts are expecting with 85% certainty that by the end of the year, we'll have at least a 0.25% increase on the federal funds rate. What's interesting about that is that Warsh, the new Fed chair, is saying nothing about kind of predicting the future with what the markets are going to do. He's actually saying rather than having the Fed lead the markets, he wants the markets to lead in terms of informing the Fed what it needs, how it needs to behave. So they're not providing forward guidance. We have no idea from their own words about what exactly they want to see happen. They're simply going to respond to the economic data as the events unfold. This is frankly a refreshing change in the Fed in its stance. Rather than being a newsmaker itself, it's allowing itself to see what's happening and respond in the moment to what's actually needed rather than forecasting its decision well in advance. There's a pro and a con to this. We've talked about that plenty of times on this podcast. Bottom line, I actually think it's a good thing. As we wrap up this week, we want to encourage you to keep your heart and mind on the Lord. Look, we live in unstable times. We live in a market that is unstable. And here's what I'd like for you to remember. From 1 Timothy chapter 6, Paul calls Timothy to charge those who are rich. He says, now for those who are rich, don't put your hope in the uncertainty of riches, but trust in God who richly provides you with all things to enjoy. So today, as we invest in the market, as we save for the future, don't trust in your riches. Don't trust in the markets. There is uncertainty here, but you can trust in God. He is good. He is faithful. He will take care of you. He is worth all of your trust. He is worthy of all of your trust. You will not be disappointed. Look to him. Reach out to us here at the Life Financial Group. If you are looking for help to become an even better steward of all of your assets, we exist to help and serve you. So reach out to us at our website, and one of our team members will be glad to meet with you and help give you direction and advice on how to steward your wealth for his honor and his glory. Until next time, take care, God bless, and be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.